The Atlanta Fed GDP Nowcast is projecting negative 2.4% for Q1 economic growth. Has the recession already started?
Our research suggests no. First, we're thinking economic growth in Q1 is tracking more like 1.5% positive. Two, our recession signal is not active. And three, the Atlanta Fed GDP Nowcast is assuming or implying that a record surge in imports before the tariff announcements will continue, although at a lesser magnitude, after the tariffs were put in place. And of course, that doesn't make too much sense to us. It sort of would defeat the whole purpose of tariffs. So we think that Nowcast is underestimating Q1 growth quite significantly.
We've seen some significant trends reverse course here to start 2025. The Republican sweep portfolio is on sale, the US is looking less exceptional by the data release, and the Magnificent Seven is on the verge of losing its nickname. What do investors need to know here?
First, small cap stocks in the US are cheaper than they were pre-election, even though they're somewhat insulated from tariffs and stand to benefit from deregulation and tax cuts. Two, the economic growth environment outside of the US is improving dramatically. First in Germany, and then in China, and then finally within the US, value stocks are still up, even though the Magnificent Seven is now entered a bear market.
Hello and welcome to the Outlook by STRAT. Mike, we've seen some pretty significant reversals of trends here to start 2025. And in our view, the biggest driver of those trends has been the Trump 2.0 agenda. We talked a lot about leading up to the election, the biggest priorities there, tariffs, tighter immigration, and lower taxes. And when you think about the agenda that's been implemented, no major surprise. But what has caught the markets off guard has been how these items have been implemented, particularly the negotiations around tariffs.
Right. If you think back to where markets were at post-election, they were pretty much just focusing on tax cuts and deregulation, the crowd pleasers, if you will, and sort of calling Trump's bluff a little bit on the tariff side. We've said all along, we've been taking President Trump seriously, but not literally. And it turns out we were taking him a little more seriously than the market was, right? And so that's been a big reset of a lot of these trends since last fall and around election time. And the surprise that we would say was a surprise to us and everyone else is just the amount of uncertainty that the Trump administration has created through the DOGE cuts and through the tariffs. How they've been negotiated, the on again, off again, constant stream of headlines. And it's, for lack of a better term, it's sort of paralyzed businesses. They can't make long-term strategic plans, fixed investment, things like that, especially anything related to government contracts. Right? And so you have to try to quantify the cost of this uncertainty component, because there is a real cost to the economy. The best way that we can think to do that, the Fed's a little bit ahead of us here. They created something called a trade policy uncertainty index. There isn't yet a DOGE policy uncertainty index. Maybe they're working on it, but at least you take the trade policy side of it. And what you see is the trade policy uncertainty index is double the previous all-time high. It's almost off the chart. And the prior all-time high was the first Trump administration, the first Trump trade war. And you can try to, once again, quantify the impact here. Back then, the Fed's equilibrium models for how they thought the U.S. economy functioned suggested that level of uncertainty would shave about 1%, 1 percentage point off their GDP growth estimates from their baseline. So if you assume sort of a linear relationship, you say, okay, 2%, tough to call, right? And also about 4 percentage points off their S&P 500 return forecast from their baseline. So you think about where we're at today, economic growth expectations are moderating, but we're sort of, we're in the early innings of this uncertainty, right? And the S&P 500 shoots first, asks questions later. It's down about 8.5% from its all-time high. So you're seeing the uncertainty weigh on financial markets. The thing for us is, if this continues, it could have some real negative impacts on the economy. Right now, we're primarily just seeing it through the trade channel. But if this goes on and on and on, it could have potential recession implications. The other thing everybody has to keep in mind here, President Trump could bring this down to zero overnight if he wanted, right? So where is his pain threshold? How much pain can he inflict on the economy before he starts to worry about midterms, the idea of a recession, things that, we know they don't want to lose their majority, and we know they don't want to create a recession.
Yeah, right. Yeah, a couple of different incentives at play there.
Yep.
Yeah. And so you talked about the cost of that uncertainty growing as the uncertainty remains over time. We've already seen some of that cost of the uncertainty, albeit in projected economic growth numbers, but the Atlanta Fed GDP Nowcast model essentially falling off a cliff here in early March as some of this uncertainty plays through.
Yeah, suggesting Q1 GDP growth is tracking at negative 2.4%, which if that ends up being the final number, that would be a huge shock to us. When we look at not only how this model is constructed, but our own forecasts and all the data we're taking in, we're thinking it's tracking somewhere closer to a positive 1.5%. And just to show how other folks are calculating it, you can see other similar Nowcast models are up at the 1.7 to even 2.7% range. So where's this disconnect coming from? If you look at that Atlanta Fed GDP Nowcast model, there's a negative 3.85% detraction from the net exports component of GDP. And so you think about where that's coming from. We had a record surge in imports in January, ahead of the tariffs, front-running the tariffs. That results in a huge trade deficit, huge negative net exports, which detracts from GDP growth. What's not in here, or what should be baked into this, is that's not sustainable, right? Once the tariffs start to get implemented, imports will slow. That's sort of the point of the policy. So net exports should sort of moderate here. And then the other side of this front running of imports, of tariffs, you get all these imports now, it results in an inventory build later. And that inventory build should boost these growth expectations as well.
Yeah. So
we think this is pretty sharply underestimating growth in Q1. We would take it with a grain of salt.
Yeah, yeah. Mm-hmm. Some parallels there too to what we talk about with the Fed of potentially being willing to look through the inflation caused by the tariffs. Right. This is just the other side of that equation.
Yep.
Looking through the adverse economic impact. Taking a step back with our viewers and just checking out our recession signal remains inactive right now. The real economy, labor market areas of it seem fine, but what could be in trouble here is this market stress signal.
That's right. We're recording this on Monday, March 10th. The S&P 500 right now down about 8.5% from its all-time high, so approaching technical correction territory. What we haven't yet seen is a big widening of credit spreads, which that's typically the canary in the coal mine if a recession is coming. That's why it's in our recession signal. It's very useful. Haven't seen a big widening out there. And then just above it, talking about the labor market signal, there's been a lot of news headlines about the surge in job cut announcements in February. We've studied the Challenger Gray and Christmas job cut announcements over and over. We decided to build our recession signal not focusing on that data, too many false positives, and instead focus on weekly jobless claims. Much more useful measure of sort of real-time firing activity in the economy. And those have increased a little bit, but are nowhere near levels that we would say are consistent with a potential recession. So, we don't speak to recessions and probabilities. We know speaking that way gets a lot of headlines, but we would say we're starting to see some very faint signs of stress in our recession signal, but nothing that would get us to start positioning portfolios for a recession.
And so to those aforementioned trends that have reversed here pretty notably in 2025, let's start with our Republican sweep portfolio that we were talking about throughout 2024. A pretty incredible round trip here in terms of relative performance compared to the S&P 500, as markets really seem to be focusing on the tariffs and the uncertainty around those tariffs.
Yes. And this goes back to what we said earlier on leading up to the election, shortly after the election, the market really just wanted to focus on the crowd pleasers, the tax cuts, the deregulation. So if you constructed a basket of securities like we did that consists of things like small caps, regional banks, oil and gas companies, things like that. And then some short exposures, shorting things like Chinese stocks. We're about to launch a trade war. We're in the midst of a trade war there. What you get is this basket of securities was the big winner in 2024, outperforming the S&P by something like 30%. And this basket of securities peaked out somewhere in mid-January when the market had to start taking President Trump more seriously about tariffs and adjust to the uncertainty created there. And now that basket is down 25%, that Republican sweep portfolio. So there are some areas here that were just overhyped to begin with.
Yep.
But what we're talking about with clients is you have to remember to take the whole look at the policy agenda in its totality, right? The market just was focusing on tax cuts before and not tariffs. Now they're just focusing on tariffs and not tax cuts. There's something in between there.
Yeah.
And as a result, there are some opportunities here. Some areas in that Republican sweep portfolio, like small caps, for example, they're cheaper than they were pre-election. And to us, given everything we're seeing in the economy and earnings, that doesn't make a whole lot of sense. They seem like the baby was thrown out with the bathwater. So we've liked small caps for a long time in our investment framework, and they just got cheaper, which is a good thing.
Yeah.
Yeah.
So potentially a macro environment that isn't as bad as it seems.
Yes.
For U.S. small caps. And speaking of macro environments, another thing we heard a lot coming into this year is the phrase U.S. exceptionalism. And we've talked about how in markets, foreign stocks have outperformed pretty notably, but now starting to see some pretty major shifts in terms of economic expectations as well.
Yeah, a couple ways to measure U.S. exceptionalism, aside from just looking at the performance of U.S. stocks versus foreign stocks. One is the strength of the dollar.
Yep.
The dollar strengthened about 8% from the fall up through late December. And then the other one is the difference between our short-term bond yields here in the U.S. and the short-term bond yields in other developed markets around the world. Yeah. Because that short-term bond yield has a lot of information in it. It prices in economic growth expectations, central bank policy expectations, inflation, et cetera. And the idea was we were just going to have higher short-term bond yields than everyone else because our economy was the best. And the U.S. economy is still exceptional, but those bond yield differentials have narrowed tremendously. The dollar has weakened significantly. It's kind of like the U.S. is still exceptional, but the spread had gotten too large a little bit. And you think about what happened in Germany. I mean, this is a bit of a sea change, really unifying around the idea of owning their own national security and defense spending, creating an infrastructure budget, and willing to run much larger deficits. And you're seeing economic growth expectations for the Eurozone increasing over 1% now, just based on this news that's come out in the last week and a half. So we've been saying for a while, when it comes to foreign stocks, yes, they look cheap. The currencies look cheap. But we would want to wait for at least one of two things. The tariffs go from underpriced to overblown. We're on the way there. We're not there yet.
Yep.
Or the economic environment outside of the U.S. start to improve. And this is the type of thing that would lead to secular higher economic growth outside of the U.S. That you combine it with China coming out and reaffirming their 5% growth target for 2025 amidst a trade war, which means one thing, they're going to stimulate their domestic economy.
Yeah.
That's favorable for economic growth outside of the U.S. as well.
Yeah. So certainly signs of an improving macro environment for foreign stocks.
Yep.
Another area of the market where we did have expected a reversal to play out here for some time, the Mag 7 looking far less magnificent here in 2025. The darlings of 2024 down pretty significantly, which we think speaks to at least some aspect of a rotation.
Yeah. The Magnificent Seven, since they reached their all-time high in mid-December, they're down 20%. And a basket of Chinese tech stocks has now outperformed them since the beginning of 2024. That basket of Chinese tech stocks is up, over 50% since late last year and then in January. And a couple catalysts here. One has been DeepSeek. We talked about DeepSeek being sort of a shot across the bow for the Magnificent Seven. There's an AI boom going on in China right now. That's why you're seeing this. Going back to the outlooks heading into the year, I think if anyone said within the first 2 months of the year, you're going to have an AI boom in China, the Mag 7 are going to be down 20%, and Chinese tech stocks are going to be the big winner, I mean, they would have been laughed off the stage, right?
Hot take.
But crazy things happen in markets because the Magnificent Seven were priced for perfection. And after being down 20%, they're still not cheap. So this speaks to what we've been talking about for a long time.
Yeah. Investors
look for excuses to sell high and buy low. And they got an excuse, and they've been doing that.
Yeah. Well, the markets continue to try to digest these changing narratives, and we'll be sure to continue covering these items for you on the Outlook. But if you have any questions or comments, please feel free to reach out.